The other way to do research is you basically just happen to stumble upon something and then try to understand it. Many things have been developed that way. I mean, that was probably the primary difference between Adam Smith, who didn't understand how the economy worked and went off to discover how it actually did, as opposed to Marx, who pretty much looked at the economy and said, well, I don't like the way it works and it functions against what I believe. So he comes up with his theory about labor, etc., and profits and capitalism. And he goes off to prove that his theory is correct. So in school, actually back in high school, I found it contradictory, because I would go to physics class and they would say nothing is random. Then I would go to economics class and they would say everything is random. So we can manipulate it, we can eliminate recessions, depressions, and the government can take care of us forever. So these were the two theories that were contradictory, and it kind of really bothered me. Then what happened was, because my father was going to take us to Europe when I was about 13 for the summer, I wanted to earn my own money. So I really got a part-time job in a bullion store. So I knew what gold was worth. It was $35 an ounce back then. And then in history class, the teacher one day brought in a movie called, Toast of New York.
Gentlemen, President Grant is releasing unlimited gold from the United States Treasury. The gold corner is broken.
It was about the Panic of 1869. And in there is a scene where the character Jim Fisk turns around with the paper tape on gold that was trading on the New York Stock Exchange at that time, and turns around to his girlfriend and says, Josie, gold hit $162.
You can't lose. 162 and a half. Josie.
Jim.
Look, Josie, 162 and a half. I got them cornered. I got all the gold there is. They've got to buy from me now at any price I name.
Now, that really disrupted everything I thought and was being taught in economics. And the idea was that everything was linear. So inflation progressively would move, etc., and the economy grew steadily. All of a sudden, here we have a film that said gold was $162 an ounce in 1869, and yet it was $35 today. So first I thought basically it was just a movie and it was not correct. They just made it up. But it bothered me, and I went down to the library and I pulled out the old microfilms and I looked, and lo and behold, there was a New York Times quoting gold at $162 an ounce in the Panic of 1869. So suddenly my linear idea of the world was completely wrong. I then saw that something could be substantially higher and then decline. And also in the late 60s, I watched real estate rise and then fall. It goes from a period where everybody wants it to next year, nobody wants anything. The rise and fall of markets was tremendous. I had earned some money. My father told me to, in 1966, he told me I should be investing more conservatively rather than fooling around with commodities and invest in a Fidelity Trend mutual fund. So I did, listened to my father, and I bought it around $54 or whatever it was, and it promptly fell to about $7. And I turned to my father and I asked him, is this the way conservative people make their money? So everything I saw would go up to a boom and then a bust. So this whole idea that the government could eliminate the boom and bust cycle was just absolute nonsense. So I basically had always had a curiosity, I would say. And later on, I was doing some research in the Firestone Library, Princeton University. And I came across an old article in the Wall Street Journal from the Panic of 1907. And in there was a list of panics. So they covered from 1683 up to 1907. And here is basically the list. So I took this from the Wall Street Journal. I simply added up the period of time, which was 224 years. And I divided by the number of events, which was 26. And I came up with an average of 8.615 years. So I thought it was just an average. I didn't really think of it as being some sort of definitive thing. And I started looking historically and trying to see if there was some sort of regularity to the business cycle. And the more I investigated, the more I found it actually was following this particular time series. So it really became quite interesting because in reading all the newspapers at the time, I would see that this thinking process also changed. And so I ended up coming up with what I would call the public versus private wave. For example, during the wave that peaked in 1929, I would read the newspapers and they would have a completely different view of interest rates. If interest rates continued to rise, they looked at it as being bullish. And why? Because they said, well, it shows there's still a demand for money and the economy is expanding. When the economy is contracting, interest rates are declining, which is actually correct. But what happened was, after the Great Depression, we ended up with Keynesian economics. And suddenly, this idea that the government can manipulate the business cycle and eliminate everything and create this land of Marxist utopia became very, dominant. And even Paul Volcker in the late 70s had done a speech and he called it the rediscovery of the business cycle. And in there, he explained that indeed, for that whole period of time, that we had economics was saying this was the new theory, new economics, we can eliminate the business cycle. He stood up and said the business cycle has always won. And that's why he called it rediscovery of the business cycle. And we have a very interesting situation and that the thinking process changes for generations. And some people say, there's a generational shift, and to some degree, perhaps that's correct. So as I said, in the 20s, if interest rates were rising, they saw it as bullish. When interest rates are declining, they saw it as bearish. Under Keynesian economics, we're concerned about what is the government trying to do to us. So if they raised interest rates, that meant that they wanted us to stop spending. And if they lowered rates, they wanted us to increase spending. So the entire relationship or our thinking process flips. So what I named these as being public versus private, and a private wave raising interest rates is bullish. And indeed, even if we look at the Federal Reserve was raising interest rates throughout the Trump administration, yet the stock market would rally, and they called it the Trump rally. So we have to get through these myths that have often come up, and what the other, I would say, detriment to analysis that we have to be careful of is that everybody tries to reduce whatever it is with single cause and effect. And it's never a single cause and effect. So like climate, it's CO2. And there too, we have the climate change zealots, but they've only gone back to the 1850s. So, must be the Industrial Revolution because the climate is warming. But we were coming out of the Little Ice Age in the late 1600s to early 1700s. If you go back in time, you find that there were warming periods and cooling periods. Go back to Roman times, you find Cicero complaining about pollution. They were using wood to heat homes and things of that nature, to the point that the first Clean Air Act was actually put in place by the Emperor Justinian in 561 AD, because everyone burning wood also creates CO2, and it also creates more pollution. So, we have to look at things more from a total global perspective. And what I've seen is how the psychology changes between these waves of public to private. There's more to it even than that. And I would notice, being a trader, that trading, any particular market, towards the end of the day, all of a sudden it would drop off and be a little mini crash. And then that same pattern of rising during the day and then dropping for the close would then migrate to the weekly level and then to the monthly level. So I began to see patterns in trading. And that was very significant in the sense that then I realized that time is very important, but it's also fractal. So what takes place on the daily level are patterns that then migrate to the weekly, monthly, quarterly, and yearly level. So what are we looking at? We're looking at really not a particular instrument, if it's the Dow Jones or gold or the euro. We're looking at human activity and how we respond to news, be it bullish, bearish. We rush into markets, we panic out of them. And during the 87 crash, what was discovered by the Brady Commission, that I was called into to provide, a lot of this research, that they immediately assumed that the market crashed because of computer trading. And what they found was exactly the opposite, that the computers all were predicting, here comes a crash, but nobody believed it. So most of the fund managers, they simply unplugged their computers. And then what happened when the market reaches a point, what really makes a market crash is something different. It is not some giant short seller that comes in and pushes the market down. Every investigation since 1907 has begun with that theory. Never once have they ever found some giant short position that ever caused the crash. Instead, what happens is the opposite. Everybody that's ever thought of buying has already bought. You now run out of the energy to continue to rise. So it's kind of like raising your hand. Yes, we can all raise a hand, but keep it there. All of a sudden, your arm gets very, very tired. You can't hold it up, and it becomes so heavy that you have to collapse. When the stock market collapses, what happens is simply that. Everybody that has bought. There isn't another sucker to come in to buy the next high. And why do I say that? Because I was giving a lecture in Tokyo in 1987. And what I found out, or I would say 1980, I was giving a lecture in Tokyo after the 1989 crash. And there was this guy that had bribed his way to get in because it was an institutional session. And he came up and he apologized. And he said, I just had to talk to you. And I said, what was so urgent? And he said that he had bought the stock market actually the very day of the high at the end of 1989. And what I found interesting was that his purchase was $50 million. It was the first time he ever in his life invested in stocks. So now I actually met the guy that bought the high. And I asked him what caused you to do that. And he said brokers had called him for 7 years and said, look, every January the market goes up 5%. So he watched and watched and watched. And so he finally became convinced. He bought it at the end of December, expecting just to make 5%. Then what happens? The market crashes. He's sitting there with a 30 to 40% loss. He doesn't sell because he's afraid to take the loss. Taking the loss means he has to admit that he was wrong. So it's very fascinating that a market will crash largely because you've run out of buying power. Then all the longs turn, they try to sell, there's nobody there to buy. So you get these panic sell-offs where a market will just absolutely crash because there's no bid. So we have to understand the human nature behind these things and what is causing it. So what I've seen is that everything is fractal. And in looking at the business cycle, I found that this 8.6 year wave builds up into waves of 6 of these to form 51.6 years. And then 6 of those form 309.6 year cycles. Now, you may say, that sounds nice, and what is it all about? But effectively, then you have 6 of those that build up into these major cycles that show when the civilizations rise and fall. We're approaching one of these now in 2032. And what will happen is that all the forms of government that we know as today, which they call democracies, but they're not, they're really republics. And that will basically change and we'll end up with a new form of government. The same thing at the last time was the peak in the Roman Empire. And all the historians have basically agreed that it peaked with the reign of Marcus Aurelius. And after that, it was nothing but downhill. But we can look at these things very detailed. But what I discovered was how accurate they were, which was something I'd never anticipated.